All right, we're live and it's real talk on real estate. I want to go over today creative financing, what it's done for my ability to expand and grow over the course of time. I'm going to give you guys four different creative financing methods that we've utilized over the course of time. And these four creative financing options are the four most popular and more vastly utilized forms of creative financing. There's multiple ways to creative finance your projects, but these four are available to you with better bandwidth. And you'll understand why as I move through this video. Now, I'm going to give you examples of each of the four ways to creative finance real estate. And don't limit your thinking to just the four examples because I want you to expand it. There's so many different ways. We'd be on here for probably a full day. I can go over creative financing for 2 days straight, give you guys examples and trainings on it. But today is really meant to give you guys the four types of creative financing, give you guys some options for execution, and also explain to you exactly how you can take advantage of different types of real estate purchases through creative financing. So let's get started. When I was first starting out in business, I had a 460 credit score because of my earlier years in business and in multi-level marketing. And I had horrible credit and I was six figures in debt to the prior company. So my bandwidth to be able to purchase real estate through banks was very limited to almost nothing. And so creative financing was the only option that I had to be able to get started in real estate. So if you're a new real estate investor, or if you're 18, 19, 20 years old and don't have credit, but want to get credit, or even if you're older and don't have credit and want to get credit, or if you've had a bad run in your life and don't have the ability to clean up your credit instantly, but want to get started today, then listen up because this is for you. For anybody that wants to expand their portfolio, and you're limited because we're all limited. There's never more money than you have the ability for deal flow. Deal flow is always more abundant than money. The true fact of the matter is that even the wealthiest of people in the world, as you grow, there's levels to the game. As I sit here in the Bahamas right now, we're out and we're walking past all the yachts, and there's just some badass yachts out there. But I'll tell you guys that there's these ones that are like, are just shy of $1 billion. They're massive. They're like flying condominiums on the ocean. And then there's these other ones that are nice. You sit back at them, and when they're not sitting by the other ones, they're really attractive, really good looking yachts. They're $100 million yachts. But then you put in a $500 million yacht right by it, and it makes it look like child's play. Okay. So it doesn't matter where you are on the spectrum, where you are in the game, there's bandwidth for everybody. So let's talk about the first type of owner financing, which is probably the most famous one, and that's owner financing. Okay. Owner financing is when the owner themselves of the property acts in lieu of the bank. Okay. So instead of going out and getting a bank loan, the owner of the property will give you financing on the property. So I've used this in multitudes of ways. I'm going to give you two examples right now how you can utilize it. One of the largest ways that we created passive income through real estate in early years was value add assets, typically distressed retail. And right now, the number one asset class that's distressing real estate the greatest is office. Pay attention to office, guys, because office needs to be repositioned. If you can buy office low enough, you can reposition it in either into a different asset, or you can leave it as office, but you buy it so low, your rental rates can just drop, and you can take that asset out and lease it for lower lease rates, still make money, still cash flow, still make money, still cash flow. We've purchased some of these assets as low as $40 per square foot. You can't build these assets for even half of that or double that. And so here's the thing. Owner financing gives you bandwidth for growth. So at a time when I had horrible credit and I needed a building for my, to be able to have my construction company in, I didn't want to have to pay rent. And when I was in multi-level marketing and I was going in and I was actually leasing office space, making a living off of leasing office space, I said, okay, why don't I just buy a building bigger than I need for my construction company? And when I do that, I go in and I lease out the building and I have free rent. Right? I mean, I'm mortgage free. So when I went out and I started buying value add retail, I just found the ugliest properties around town that were financially distressed. I'd buy them for very little money down. I'd go in and put almost nothing down, sometimes nothing down. The first building I bought, I put almost $0 down on, but it did cost me a little bit of money to renovate it because it was so distressed. Now, we were able to go in, put almost nothing down, This property had been heired to a gentleman who was a scientist, didn't know nothing about real estate. His dad was a real estate guy. He went out, became a scientist. When his dad passed on, he got left this retail building, and he didn't have a need for it, didn't have the desire, didn't have the knowing knowledge. And he was already in his 50s or 60s at that point in time in his life. I'd probably say closer to his 60s, and didn't want to have to deal with it. It was more of a burden to him. So it was my grace that went in and said, hey, why don't you just owner finance it for me? You're going to make more money because I'm going to make you monthly payments. And I'm going to make you interest payments every single month. It's going to benefit you. Plus, if I buy this building from you today and I get a bank loan and the bank pays you off 100% in full, you have a tax liability. Now you have to pay estate taxes or capital gains taxes. However you took ownership of that from your dad's death, you're going to have to pay either estate taxes or capital gains taxes. So if I buy this building from you for hundreds of thousands of dollars, 40% of it is going to go to the IRS instantly. Or we can offset the capital gains tax by doing owner financing. You can finance it to me. You only have to pay tax on the money that I'm giving you in payments instead of the entire asset. Now you have bandwidth of time to figure out a tax strategy to be able to offset your long-term capital gains taxes. So one of the things that benefits sellers is that bandwidth of time to either find maybe a 1031 exchange or to go in and find a larger asset or offset it against losses maybe in the stock market. But you can find a tax strategy and it delays that tax strategy. Or maybe it buys you enough time to retire, not have your active income. So maybe your tax liability goes down in the time frame that you actually have to pay the taxes, but it buys them time. You get a lower interest rate. There's no credit check required. If they require a credit check from you, it's because they're just being conservative, but you can actually dispute that and say, nope, I don't want to have a credit check done because there's no requirements of a credit check. And you can go in and just buy with zero credit, zero out of pocket, or very little out of pocket, or at least lower amounts, because if you're buying as an investment, the banks require at least 20%. In today's world, 30% or greater. And so you have very little out of pocket. So great way. Now, second great thing about owner financing, land. Let's talk about land. Since a lot of you guys that follow our content are buying land, building houses, and generating six-figure profits, let's talk about land for a second. Our first house, again, I didn't have the bandwidth to be able to go out and get a construction loan like I teach. I wish I would have had that benefit at the time. I was rebuilding through business lines of credit, but in that day and age, I didn't have that luxury. So I had to get creative with how I financed stuff in lieu of taking down my first build back in 1998. And we're teaching our students how to do this today. They're still utilizing it. It's great bandwidth. Is you take down the land through the means of owner financing for the same purposes and the same way that you do a building is the same thing with land. Now, when you take down owner financing on land, what it gives you is the ability to offset the cost of that. Now, when I negotiate land, I tell the owners, why don't we offset the interest payments to the back end of the loan, and we'll be done with it in 6 months. So let's do me a 12-month owner financing on the land, and then I'll finance out the land paid in full in 12 months and all the occurring interest. That way you don't have any interest payments. You're not paying monthly payments, and you don't have the stress and burden of having monthly payments month after month on the owner financing. Now, if you don't plan on turning it in 12 months, you're going to hold it, then you'll land up paying out the payments on it, but it'll offset the large expense of having to pay for all the land up front, okay? Especially if you don't have the ability to get a construction loan. Now it gives you the ability to go out and get a HELOC, home equity line of credit, business credit, whatever you're doing. So like as you get into like buying land and building 2 houses at a time, maybe you can get a construction loan on one, but the second you can't. So you go in, you start building business lines of credit to take on a business line of credit for your second build, while you take on a construction loan for the other build, and you're able to owner finance the land and use the business line of credit to pay for the actual build, while the land is paid for through the means of owner financing, not a bank lending. Okay. So owner financing, 2 great deals. Let's talk about option number 2, which the second best way for creative financing is what I call loan assumptions. Now, what's good about loan assumptions on assets is that if somebody else has a loan that they have out on that, there's 2 different reasons that loan assumptions are really great ways to creatively finance a project. Is that the loan terms are already set in place. Now, the deed of the property and the loan, the note on that property, are 2 different documents, okay? So don't get confused. Again, I'm going to repeat that. The deed on a property is one document, and The loan, the note on the loan is a second document. Okay. So you could take the deed in your name, the loan can stay in their name, and you assume that loan. You take that loan and you assume it on the current terms. Now, in multifamily, this is a great thing right now because right now interest rates are higher. Now, let's say that somebody got like a HUD loan, for sake of example, 5 years ago, and interest rates were at 3%. And let's say the HUD loan is a 40-year stabilized loan with HUD, because that's what we're doing right now. We're buying down our interest rates to about 4.5%. We're signing them on 40-year terms, fixed. And so you have consistency in what your payables are. It's not like a 5-1 arm where you have this fluctuating rate mortgage. So why is it beneficial? Because most syndicators, most investors finance these projects at the lowest cost of financing that day. And the problem with that is when interest rates rise, when your loan's about to graduate and come due, then all of a sudden you're on a volatile adjustable rate mortgage, and now your liability goes through the roof. So the benefit to doing a loan assumption is if you find an asset that has a great loan, maybe the terms aren't perfect, maybe the price of the asset is slightly higher, but through the means of having better terms, you can't even get the price. You can't even get the price to pencil even at a better price if the terms are bad. And it's happening right now all over the country. And in fact, there's $2.7 trillion worth of loans that are going to come due over the next 12 months because of what happened in banking, where interest rates are not high right now, guys. It's just that interest rates went too low. And when interest rates went too low, values went too high. Not interest rates, values went too high exponentially, too damn quick. And because of that, people financed under ridiculous terms with ridiculous notes, knowing that it was historical lows on interest rates. We've never seen interest rates this low historically, ever. But yet people still did it. They bought frivolously. They did these 5-1 arms, knowing that historically loans had never been that low. Stupid, stupid, stupid. Now, with that said, there was some people that are smart enough to get low-term loans with long-term notes. And those long-term notes hold their weight in gold because now that interest rates are at 6%, 6.5%, 7%, and your cap rates have to run in alignment with them, money's expensive, asset values are down. You can't refinance out of them because the values have dropped so much because interest rates went back up and stabilized. The only way to get out of these notes is if you have a stabilized long-term note that has a decent interest rate that pencils today. And if you don't, then you have to sell your asset for a depreciated amount, or you just have to keep it, pencil it, service the debt, and ride out the storm. Okay. Now, with that said, for those of you guys that have stabilized loans with great notes, that's why we're doing HUD loans on our big assets, because they're advantageous and they keep our product and they keep our product safe, they keep our assets safe, they keep our ass safe, and they keep all of our money right. Okay. So loan assumptions are important right now to pay attention to if people have good long-term notes. That's when you use them. Okay. Number 3, let's talk about land deals. Let's talk about big multifamily for a second. And let's talk about big land development deals. Because every time I get with somebody that wants to buy land, build houses, they're like, I got this 32 acres worth of land. I want to develop it. Or I inherited this 15 acres. How do I make this work? Okay. And so when people are going out and you're buying larger assets, the biggest thing is, how do I de-risk this project? Like, how do I get into it without putting my ass on the line and making sure this project is safe? And the way is the third way to creative financing, and it's to buy on an option. Okay. It's where you tie up the property, you control the property, but you actually don't take ownership of the property. You control it, but you don't own it. You control it, but the prior owner still owns it. It's in their name. You just control it legally through escrow, through your contractual agreement, but you're purchasing it on the option to buy. You haven't purchased it yet. Now, that option is executed with different terms. Obviously, we don't have enough time to go through all the terms of an option right now, but let me give you an example, okay? Let's say that you take down a 40-acre development. Big developments, guys, are high risk, okay? Because there's a lot of money out of pocket. So if there's a lot of money out of pocket, the only thing you do to yourself is put yourself under larger financial distress if you buy the land outright, or now you have debt service on the land because the bank is coming down on you. Even if you owner finance this large stuff and you can't back into the owner financing with them taking the interest payments at the back end, If you have to pay it monthly, it's called trash can money, because as you sit in that land, it's costing you money every single month, and that monthly burn is increasing your liability. Now, you might even think that on the back end it can service the debt on that, but you're increasing your liability month after month because that debt service is increasing your bottom line of the ownership value of what you're into that land for. So that increases your risk and liability, because every month it's harder for you to exit that property, especially if you bought at fair market value, because you bought at fair market value and it takes you a year to develop the land, get it entitled, and sell it. If it takes you longer than that, every month your base goes up a little bit and your liability also increases and stair steps up. So the way you offset this is you go in and you set up a purchase through the option to buy, saying, hey, I'm going to buy your property. Here's the terms. You work out all the terms in advance on a purchase agreement. You both sign and agree to the terms of the purchase agreement and say, I want an option to buy this, but my option expires in 24 months. Now, my option is also contingent on my ability to subdivide this land into 40 lots. If I get less than 40 lots, the deal's off. Right? So you go over your minimum density. Now I'm going to execute to try to get 50 lots on that land. And if I go in and, for sake of example, I get approved for anything 40 or greater, no problem. That's my contingency. Now, that contingency also holds my liability. So if I get into a municipality that's giving me hell and not allowing me to be able to go in and close on that land because of the fact that they haven't approved our master plan, and they don't want us to be able to, let's say the neighbors are giving us a hard time and they don't want that density, then I can go back in and renegotiate with the owner, say, hey, my terms are based on us being able to go in and get 40 lots. They're only wanting to approve us for 36 lots. So if I do a dividend of a price per lot, that means our price has to come down $130,000 or whatever it might be, right? Theoretically speaking. And now you could take a per unit value on the land, and based on what you don't get, you can decrease the price, or you can exit the deal without the liability because you can't get it to pencil correctly. Or you go in, you get it successfully, or if it takes you longer to get that approval, you can go in and exercise that contingency on that option that you have and say, hey, I know we said 2 years, but it's taken us 2 years to get this far. We need 6 more months to be able to get to the finish line. You still only hold the liability of what you're paying to the municipality and your surveyors to be able to get the site development approved. So you don't have the liability of the land yet, or the debt service on the land. Very, very important, because it de-risks your project. Meaning that you have the ability to go in and execute strategically, effectively, and most importantly, without risk. Okay? Risk reduction. We're dissolving risk. So an option is a great way to be able to go in and de-risk projects. You can also do this on large multifamily. We do this when we tie up land, when we're building large multifamily. Same thing. We go in with a contingency on a minimum density. Like right now, I have a density minimum of 150 units on my Cibola Loop project. Well, we went in and we executed to try to get 180 units. We were successful getting 171. We knew that anything over 150 was a bonus, right? So now we're 21 units over the 150, and we always start high. We get dropped down a little bit by the city municipality, tries to humble us back down, but we're still over what our underwriting was. So now we're 21 units over. We were originally supposed to close last January on our Cibola Loop project. And then because of the contingency we had on the option to purchase, so we still haven't even taken ownership of the land. We tied it up over a year and a half ago. We were supposed to close at the first quarter of 2024. We went in, we got reduced. We found out there was some road issues and some declaration issues on the road. It took us longer to get our site plan approval. We had to negotiate those. That took us to an extension in July. We got to July. We negotiated those, but now we had to go back in and start our site development. And we said, okay, November. Then we got all the way to November. And once we hit October, we knew November wasn't going to work because we still hadn't got our site development approved based on the roadways and the changes that the city had to those roadways. And so we were able to get an extension out to this February. So now we'll have approval in January and we'll close in February. Our debt service and liability won't start until February of 2025 because of the option and the way we actually closed. We controlled the land, so we knew we had control over the land, so we had less risk to be able to execute, but we decreased our overall liability financially because we haven't had paid debt on a $2 million lot for over 18 months of us having it tied up. That is strategic. And that is how you get creative with your financing. Now, last but not least, let's talk about sub two. Sub two is great. And here's why sub two works so well, guys, because sub two is when you're buying a property while taking the owner's remaining mortgage balance, and you don't assume it, you're just taking over it. So again, two things: the deed and the loan are two different notes. The deed and the loan are two different notes. So when we talk about a property, when you talk about buying it sub two, you can go to escrow with a sub two agreement, and the deed can get changed in your name, so you have legal and rightful ownership of it. And now the bank still is in first position. So if you default on that loan, and even though you own it, the loan is in the old owner's name. And what ends up happening is the bank just wants that money, guys. The bank just wants that money. Okay. So as long as you're servicing the debt on that loan on behalf of the prior owner, you are buying the property subject to the current terms of that loan. You put the deed in your name, so you have rightful ownership, but the loan is still in the prior owner's name. And as long as you're okay with those, with the terms of that note, then you take rightful ownership of it, and you just are taking the loan subject to the current parameters of it. Now, what's beneficial about sub two is you can go in with very little money out of pocket, sometimes no money out of pocket, depending on how good you negotiate. Now, sub twos are all about negotiation and all about you being able to get creative on how you strategically position your buy into that property to take over the ownership of it without taking on the ownership of the loan, just go taking the terms of that loan subject to the current values. Now, look, ladies and gentlemen, those are 4 different ways to strategically position yourself to take advantage of creative financing. Any one of those 4 methods is like a tool in your toolbox. You can't build a house with just a hammer. You're going to need a saw too. You can't go out and be a mechanic on a car with just a crescent wrench. You might need a screwdriver. You might need a socket set. You might need an impact wrench. So depending on what day and what environment you're in for whatever asset class you're purchasing, you're going to need different tools. Those 4 ways of owner financing can strategically position yourself to be able to go in and take down the vast majority of real estate purchases, depending on what you're buying, how you're buying, and the position of the current ownership of that property. But through the means of creative financing, it gives your bandwidth for execution, makes it a lot greater and a lot more abundant. And that's how you start in real estate if you don't otherwise have the bandwidth for credit or execution, or you run out of the ability to utilize your own personal credit because of your debt to income ratio, or because you have an established business credit, or you don't want to leverage your personal credit because maybe it's a higher risk deal. All of these creative financing options are tools in your toolbox to utilize, execute, and strategically position yourself to win, grow, and scale your portfolio, and ultimately compound your success. Ladies and gentlemen, for more content just like this in real estate, to continue learning how to buy, purchase, and build real estate, then click and subscribe to our YouTube channel. Give us some love by pounding that thumbs up button right now. And I look forward to seeing you guys next time. I'm going to recommend a couple videos to help you guys out with owner financing, single family real estate, and multifamily real estate as we move into the new year in 2025. Thank you guys from the Bahamas. Go out and compound your success. Merry Christmas. God bless you, and have a great, great evening.